Welcome everyone and thank you for joining the WAM Income Maximiser webinar. Today I'm joined with Matthew Haupt, Lead Portfolio Manager, and Damien, Boey, Portfolio Strategist. So we've received the funds for the placement and we currently have the SPP, the Share Purchase Plan at the moment. How long do you estimate it will take to deploy this capital?
I mean, the great thing about where we're invested is in the high quality liquid side of the market. So for us, the money for the placement money, I mean, it really took a couple of days. We could have done it quicker, but there was a lot of primary issuance which we were participating on the debt side, so we wanted to get the pickup, which you normally do on a primary. So we waited for the primaries, but on the equity side, I mean, it's largely instantaneous. It really doesn't take long for us to deploy. Due to the size of the investments or the companies we invest in, they're highly liquid. I mean, that's the benefit of WMX. It's in the investment grade, highly liquid markets, and also the top 100 predominantly on the ASX, which is again really highly liquid.
Do you believe that there will be a market correction and whether that's inevitable over the next year or so? And do you think it's more likely a correction or a crash?
I mean, that's a great question and one we debate every day. We do have the ingredients for a crash. We can see the path for a crash. It's low probability at this point in time, but we can definitely see it. Correction more likely at this point in time. But for us, what are we watching? What will differentiate a correction and a crash? I mean, it's really around a shock to break on the debt side, on a lot of these collateralized loan obligations and the private credit side. If there's a shock, which could be mainly through economic growth, like labour market, even inflation, or just like a redemption event. If there's a redemption event in this system, it forces liquidity of the underlying assets and the whole thing sort of unravels. So it's really a low probability at this point in time. But if we do see economic slowdown and a macro shock, the probability of a crash really goes up. But at this point in time, we really think correction is the more likely event at this point in time.
Yeah, the thing about it is, and Matt alluded to it, the financial plumbing that's underpinning everything that we see is quite unique, and it's not an easy thing to break. So even when we talk about, say, 2020 or Liberation Day, notice how quickly markets, like they went down very, very quickly, but they also bounced back extremely quickly. And they did so even though people didn't really have a lot of visibility as to whether there was going to be a recession around the corner or how bad a recession and things like that. So it's really about the plumbing of the system holding together, key funding markets still being open, essentially, maybe with a little bit of help that allows people to just sort of be a little bit more optimistic about the future. So I do believe that the next wave, like even if you do enter more volatile markets, you're more likely to see these sorts of patterns of behavior where it's more of a sharp correction and then a very strong bounce back afterwards, unless the plumbing is completely broken.
I mean, that's a great point. Markets shouldn't be where they are if you're off fundamentals at the moment.
Yes.
So what we're seeing is trade wars, labour market falling apart, equities at all-time highs, and credit spreads so narrow from the plumbing. So it shows you the driver at the moment is not actually fundamentals until it's a big enough shock, which could disturb it. But we've had the yen carry trade in August 2024, lasted for about a week. Liberation Day, about a week. So the plumbing is so incredibly tight and functioning well at this point in time that these events aren't breaking it. So even now, US shutdown, US labour market where there's been a million revisions on jobs, won't break it. So it goes to Damien's point that it's so incredibly strong at this point in time that it's not causing any havoc anywhere.
And the big thing to look out for is that, you can have a series of short, sharp correction events based on the plumbing holding together. But the real question that we're asking and thinking through on the longer term basis is, if all of these concerns about private credit, the lack of transparency, the valuations that are there, and redemptions actually do come to pass, that can happen on the edges of the world, and that will still be fine. The question is, does that permeate all the way to the core of the system such that the plumbing for everything breaks? There will obviously be a lot of signposts and milestones that we'll have to go past before that happens. And so that's why we say right now it's a low probability event, because we haven't actually even seen many of those. But that doesn't mean we don't think about them.
Thank you. And can you give us a bit of a summary of what's happening in terms of dividends with the Income Maximiser portfolio, given their monthly, and maybe expectations from here where they could go?
Yeah, I mean, for us, we're tracking way ahead of expectations. So, like, we started at the IPO saying within 12 months we want to hit our run rate at that full RBA plus 250, which is the bare minimum of pass-through yield we want to generate. So in December, we've given the forecast out to then, so we can't talk past December. But it's obviously a board decision. But you look at the dividends we're receiving, the distributions, the capital we've generated. I mean, the board's in an incredible position to increase that. So again, I really hope we can get to a run rate before that 12-month. And again, it's totally up to the board, but we are in the position where we could achieve that much sooner than we previously thought.
Yeah, so if you annualize the December dividend guidance, so the monthly dividend, but you annualize it, multiply by 12, what you'll get is that is roughly 4.2% of current NTA. But if you look at our combined capital and profits reserves, that's another 4.7% of NTA right there. And so how exactly that is used in terms of distribution, that's all a board decision, but they're the facts as they are at the moment.
Thanks everyone for joining us online, and thank you to Matthew Haupt and Damien Boey as well.
Thank you.
Thank you.